When the economic environment becomes uncertain, we provide the truth from a breadth of perspectives to help people make decisions. We not only compile and analyze the data that moves our ever-evolving economy, we carefully craft our own to provide clarity across industries, businesses, and employment markets. We identify unique opportunities to deliver asymmetric returns and focus on capturing value created during periods of higher volatility, transforming the financial landscape together. We're MacroEdge.
Good afternoon, everyone, and welcome to MacroEdge Radio. It is Friday, February 7th, 2025, and this is John Galt speaking. Welcome one, welcome all, as we have a very special guest joining us today, Anna Wong, Chief Economist from Bloomberg LP. Needless to say, arranging Ms. Wong to join us on the air on non-farm payrolls and Michigan Survey Friday is an absolute treat. With no further ado, Anna, please welcome yourself to our audience at MacroEdge Radio. Oh, can you hear me, Anna? I hope. I don't know if she can hear me. This is an X problem, folks, so bear with us. It does have this has happened in the past. We will get her on the air. Anna, are you there? Uh-oh. Well, while we work out the technical problems with Anna, we shall sit there and endeavor. Let's give a quick market summary. This is part of dealing with the X technology that we're still working through and the growing pains. Even though it's been a year, it's starting to really drive everyone nuts. Anna, are you there? I don't think she can hear me. We'll have one. Anna, can you hear me now? Oh, this is quite frustrating. Well, folks, real quick market summary while we get the technical issues worked out. Dow was down 432, NASDAQ down 252, S&P down 55. Volume was moderate, not extremely heavy. The bond market was more interesting. Last quote I looked at was the 10-year finishing around 449. That is the key to watch because that is what Scott Bessent focused on for the week. And the data today is going to play a role in the future. She's going to reboot and join us again in a minute. We don't know what happened, but we'll sit there and try and resolve this as quickly as possible. The Russell 2000 was down a full 2719 or 1.18%. So that is also an indication that things aren't as they seem. There she comes. Now she's back. Anna, are you there? Oh, boy. Okay, now we'll bring her up. We thought we had her back up. And I don't know if you can hear me, but please welcome to the airwaves. We're endeavoring at every end. These X spaces can be a little bit quirky at times, and we understand that. Believe me.
Okay.
And
can you hear me?
There we go. Now we got you, Anna. Welcome aboard to
I'm so
MacroEdge
sorry
Radio.
about that. It's my Bluetooth. Somehow it's connected to a faraway microphone.
That's no problem. I've gone through the same problems with numerous guests, and sometimes it's X, sometimes it's Bluetooth, and sometimes it's just downright frustrating. Welcome to MacroEdge Radio and our team and all of our listeners. Needless to say, we're quite fortunate to have you on Non-Farm Payroll Friday and also with the initial preliminary Michigan survey. First, let's get your first impressions and follow up, because I listened to your program, your interviews today with John Ferraro and Tom Keene, of course, on radio and television. I'd like for you to expand on that as you see some good signs in the labor economy, but also some deterioration in the future.
Yeah, so, my first reaction when I saw the jobs report was surprise. I was surprised that in the post-benchmark period, which covers April 2024 to December 2024, we do not see a more material downward revision from the updates of the birth and death projections. My team had projected that we should be seeing a downward revision of 234,000 in the last 9 months of last year. And instead, what you see is that the seasonally adjusted employment level in December 2024 compared to March 2024 was revised up. So after having some more hours to look at this, what I've discovered is that in fact they did do the downward revisions to the birth death model for the post benchmark period of the last 9 months of last year. They revised it down on a non seasonally adjusted basis by about 250,000, which is very close to my own estimate of 234,000. But you don't actually see it in the data because they also did not. They also incorporated a very large upward revision from an increase of sample survey in November and December, the last 2 months of the year. On top of that, and I hope you're still following me because this is actually very complicated. On top of that, the BLS also revised the birth and death model today to incorporate different set of information in the last 2 months of last year versus the 7 months in the post benchmark period before the last 2 months of last year. So as a result, basically what I'm saying, the bottom line is that the birth and death updates in the last 9 months of last year is not yet complete. I think the problem is that BLS own model is too smooth, and they realize that the downward revisions is not sufficient, so they introduce some add factor in the first 7 months, from April to September, but they couldn't do so for November and December of last year because they said they need more time to process the data, which means that I think in the next couple of months we're going to see more downward revisions for November and December of last month, in line with the updated process of projecting birth and death models. So the bottom line is, while the people are talking about how the downward revisions were not as big as thought, I think that in fact it is hidden, it's buried in there, that there is some kind of downward revisions, and I think in the next few months we're going to see more of them.
I'm of the same opinion. I also think that we're going to see some massive revisions to all of the formulas and calculations because there have been data collection issues that we've seen across the board. Do you think that we might see some modernization and reformulation this year as we have a new Commerce Secretary, new Treasury Secretary, to sort of upgrade our data collection capabilities and improve on the formulas being used?
Well, the federal government is downsizing, so I'm not sure there will be more eyes or hands on this issue. If anything, I think I sure hope that some of the more experienced economists who are in the benchmarking office will not leave. Otherwise, we would lose the expertise on that issue. But I agree with you, John Galt, if that's your real name. I know that's from the book Endless Drug.
Absolutely, it's for personal purposes. I've had a long radio career and a few shady characters come after me. So.
Oh, okay. All right. So I agree with you that there will be more large revisions because we already have a flavor of what those would look like in the second quarter of 2024. The Philly Fed early benchmark shows that likely there's a month in the second quarter that is a negative payroll. We see no signs of that in the revised 2024 non-farm payrolls data today. We now know that they have not the updated birth and death factor is still not completely revised down, and I think for 2025 BLS is still projecting that the net birth and death model will be adding 1.1 million jobs to the economy. When in reality, I think the net birth and death is only adding 800K or so to the economy. So we are still significantly overestimating non-farm payrolls going forward.
I tend to agree with you 100% because, in my opinion, I had projected 239,000, by the way, in my own personal writings. Well, I thought it was going to be a little bit more drastic also. And I thought we were going to start reflecting the negative data because of what's been happening in transportation and logistics. And instead, they boosted that to a positive reading, which was shocking to me for December, considering the number of closures and layoffs we witnessed in that particular arena. Do you see a long-term change in the birth death model? Because that has been a criticized model for 15 years. And I know they're doing the best that they can to update it and upgrade it. But we really, is it possible with that Musk's magic could introduce some AI to help improve the formulation and the data collection? Because we do have a response issue with many employers responding to the surveys, which does tend to cause an overestimation in some arenas.
Yeah, so BLS has actually been studying about the impact of possibly moving toward using more administrative data in collecting payrolls estimates rather than calling people or seeking survey response, and especially I think in the future when a lot more of these data collection move to an automated process, they would want to rely more on administrative data. However, I think BLS is kind of like those tree folks in the Lord of the Rings movie. You know how the tree folks gather and discuss, and after a long time, they finally agree on one marginal step. I think that's basically what BLS is currently. That it takes, I think, for them to be revising the net birth and death model today, to take that step to incorporate more real time information in the updates was a big step for them. That takes, I don't know, a decade for it to happen, and I maybe it's an encouraging sign for the future that they would be more conducive toward incorporating more real time info on business formations.
Well, that brings me to my next question. My favorite measure for the unemployment rate is, of course, U6. And I am more of a non-seasonally adjusted person than seasonally adjusted. I think there's an over smoothing for the holiday period, which distorts the seasonally adjustment region during the holidays, of course, from November through December. We look at today's reading. We had a seasonally adjusted rate of 7.5 for January, but we have 8.2 non-seasonally adjusted, which seems more reflective of the layoff data that the MacroEdge team has been tracking and what we're seeing in the economy as a whole. What do you make of the differences where you have a decrease in seasonally adjusted versus increases in non-seasonally adjusted?
Yeah, I mean, it certainly makes you wonder whether the improvement you're seeing is in the seasonally adjusted data is real, and I would say that is a legitimate concern. Um, but with today's report, there's just layers and layers of complexities due to the population controls, the addition of the population controls that makes everything just much more complicated to understand. For example, a lot of the unemployment rates, U1, U2, U3, improved significantly on a seasonally adjusted basis. And however, to what degree is because BLS use um, weights in apply assumptions on the demographic weights in the new population that truly reflects the reality. One point that I'm very puzzled over is that BLS assumes that 44% of the new population are Hispanic of ethnicity and 29% of Asian ethnicity. And we know that Asians have lower unemployment rate than the average population. So if you assume that, and they also have higher labor participation rate. So if you assume that a big chunk of this new immigration are Asians, which have lower unemployment rate and higher labor participation, it basically brings the whole national average down for the unemployment rate. And the labor participation also up, and the EPOP also up. But whereas empirically, also common sense wise, we know that much of the immigration in the last 2 years came from the southern border, and disproportionately with people originated from Latin American countries. And in fact, I just quickly Googled the share of Asians or coming originating from China and India that were confronted in the southern crossing. It was only 7% of the total. So by my quick calculation, if you use the weights that the BLS used, the 44% on Hispanics and 29% on Asians, versus a 7% on Asian and the rest on Hispanics, you could actually raise the national unemployment rate by about 0.2 percentage point. So I think that the population controls that were introduced today, the 3 million addition population, really distorted some of the employment ratios that one would typically think would not be affected by a large increase in population. Those to me are more primary in terms of my concerns about whether BLS is accurately measuring the unemployment situation in the country.
See, that follows up. You hit a great subject, because when I was making my original projections, I used, part of it was the metropolitan area employment and unemployment summary from the BLS, and it seemed to conflict when you look at the increase in unemployment rates higher in 266 of 389 metro areas. That should have been reflected in a higher rate of unemployment, and in fact, not seasonally adjusted, according to that report, it went up from 3.5 to 3.8% on its own just for those areas. Is there too much conflicting data within the BLS database to really get a good picture at this time until they get a better handle on the population flows and the various industries, which are about to go through another shock, in my opinion?
I honestly don't know when the population controls problems will be resolved, because the BLS does not do backward revision in the household survey, unlike in the establishment survey. So what we got today basically will decide on the weights, demographic weights, that BLS will be using in the next 11 months. And when next January comes along, when the next January 2026 report comes along, then BLS will further update the population weights, hopefully making a correction on the demographics weight. But I'm not hopeful that it would accurately reflect what we believe is the true mix and unemployment status of the new immigrant, because the BLS does not use the nativity status of a new worker to calculate the national unemployment rate. So, for example, I think it's reasonable to think that a new immigrant who arrived a year or two ago would be still looking for a job. So the unemployment rate of the new immigrants in the microdata indicated it's closer to 10%, right? Whereas BLS does not use nativity status to calculate the employment status of a person. But I think that's the number one most distinguishing predictor and feature of the employment status of a person, is whether you just arrive at the country or have you already been here 10 years ago. And I don't see a plan for the BLS to ever address that. So I think that the unemployment rate, U3 rate, currently is understated by about 0.1 to 0.2 percentage point. And I think it's that problem is mismeasurement problem will be there for a while.
Well, that is a fascinating analysis, because you seem to indicate in your commentary today that you anticipated some deterioration in the first half of this year, which I concur with, by the way. I think a lot of the revisions are going to move forward and roll through it. A question that comes off of the side of that is we've seen an estimated 80,000 federal employees accept buyouts be terminated by the new administration. Do you think that's going to roll into the data in the next 6 months, or do you think they're going to take that full 6 to 8 months of severance and just go on vacation before re-entering the workforce? Because that is going to eventually lead to a spike, especially as more terminations occur.
Yeah, so for those who are taking the buyouts, they will be paid until September, right? For the next 8 months. And to the extent that they are indeed paid, they will still show up in the non farm payroll, the establishment survey as being employed. And if they didn't take a vacation and they did find a new job while continuing to receive the severance, then they will be double counted in the labor market, in the jobs report, in the non-farm payroll. Then come September, when the severance package expired, you'll see a sudden drop in non-farm payroll, because those people, the double paid people, would drop out of the sample. But within the next 8 months, they will be counted twice if they found another job. In the in the household survey, on the other hand, the household survey asks the person, are you employed or are you not employed? And even if a person is receiving severance pay, as long as he has not found a job and he's from his perspective, he has severed his ties with the federal government, then he would be counted as unemployed. So, in this sense, it could be that the buyout program for federal employees would show up more in the household survey than in the establishment survey in the next 8 months.
That makes perfect sense. And that brings us to our next question, because I've got one more labor economy question, because that is without a doubt, you're the go-to expert in this arena, in my opinion. And you provide a unique perspective versus the traditional perspective of many economists. And I think that is what we need to start looking for, especially since the availability to modernize data collection techniques needs to happen. Do you think that there should be an improvement on measuring the quote unquote gig economy for the 1099 workers, for the Ubers, the DoorDashes, et cetera? I would like to see a weekly survey submitted by those companies, at least of number of contractors and average active hours used, to at least give us a better picture of where that is actually impacting the broader economy.
Yeah, I think eventually, as BLS consider incorporating more of the administrative data, that they will have an increasingly better picture of the gig economy. Because I agree with you. Um, the gig economy has played an increasingly important role, particularly in the last 3 years, when inflation is so high and many people are working multiple jobs, some of which are in the gig economy.
Yeah, that multiple job holder statistic today was stunning, up another 500,000, roughly, 510,000 exactly, non-seasonally adjusted. And I mean, that really is a stunning increase for January, which could be either why we're seeing suppression of unemployment claims, or a necessary expansion of multiple job holders due to economic constraints and circumstances, as you said.
I think it's very hard to interpret the change in levels in today's report because of the population controls. But in terms of the general trend, I agree with you. I think one of the uh, main story for U.S. economy this in the first half of this year is the lack of safety net. We see a lot of the essentials for household, the inflation for those essential items continue to increase. These are like electricity prices, car insurance, home insurance, food prices. All these prices are essentials, and it means that in the absence of an increase in nominal income, the consumer will have less money to spend on things outside of these essentials. So, interestingly, in the Fed's own general equilibrium model, a spike in headline inflation prices ultimately will lead to lower prices in core inflation measures, and that's because gasoline prices, food prices, all these stuff eventually uh, make for increased hardships for the household, and I think ultimately. To pay the bills as the hiring rate is declining, households will go for the gig work, have to hold multiple jobs to pay the bills.
100% agree, and I think that's an important factor when considering, as was pointed out in the report this morning, aggregate hour works declined 0.6%, which I think is a red flag that overtime and other sources of income through employed individuals is beginning to decline. And that could be a red flag in addition to what we're going to talk about in a second. And that is consumer credit. I don't know if you've had a chance to see the report that came out this afternoon, but it was mind blowing. 40.847 billion versus a forecast of 14.55 billion, and last a 7.49 billion. So we've had a dramatic increase in consumer credit, and it does appear to be more so for individuals living off their credit cards versus obtaining new credit for cars, et cetera. What is your take on the confluence of those two particular data points and what it means moving forward to a possible slowdown in the economy?
Yeah, I think when we look at the senior loan officer surveys that the Fed administered, what you're seeing is that loan officers report that they're increasingly differentiating between the prime versus non-prime people, and I think during the pandemic, what we saw is that because a lot of people received forbearance on their student loans, and also the administration has introduced policy that allow people to stay in their homes. So foreclosures is also down. That people are, have these extra uh, room for spending their money on other things. And now that the grace period for not paying student loans is over, so it's been over since September of last year. Um, I think households, especially student loan borrowers, are starting to see their credit score fall. And from a credit supply perspective, loan officers are increasingly differentiating and restricting credit to those whose credit score are now more realistically reflecting their risk behavior. And so, um, even though the pandemic has been over for a couple of years, many of the economic impact or distortions introduced by pandemic policies are still with us, and they're only slowly going away this year. And I believe the Trump administration is not as sympathetic to always extending the grace period to the student loan borrowers. In fact, the Trump administration is thinking about abolishing the education department, right? So, and also the Consumer Bureau, Financial Bureau. So those two bureaus are most sympathetic to the student loan, um, uh, allowing for grace period for student loans. So I think that generally this means that uh, the lifelines for the lower income household it's shortened. Their credit scores are deteriorating. The cost of the essentials for household is rising at the same time, and so things are just looking more and more rough for the I would say at least half of this country.
Thank you, Anna. And I'm going to take a quick break to say, everyone, macroedge.net/ozone, macroedge.net/ozone. If you need alternative and unique perspectives on the economy and business, please check it out. Get a 2-week free trial. That's my commercial plug. And also, I must insist, if you're on X, you must follow Anna Wong, which is at Anna Economist, at Anna Economist. If you're not listening to her perspectives and reading her articles on Bloomberg, you're missing out, because there's the commercial media, and then there's individuals who are trying to present a more academic and unique approach to analyzing data. And that's why I was so happy to hear that Anna was going to join us today. So Anna, thank you again for joining us. And I'm going to follow up with this, because you hit a hard point that really strikes to the tone that some of us in the MacroEdge team believe. There's a lot of us that believe that there's an 80-20 economy, that 80% of the nation is struggling and 20% are doing fine. It seems to be based not just on credit reporting and income, but also asset holdings and management. And it's demographically based. Everyone's blaming the boomers. I'm one of them, I have to admit it, on the younger end of the boomers. But it does seem to present a problem for not just political, but economic policy moving forward, does it not?
Yes, for sure. And I mean, you can clearly see this in polls and optimism about life when you ask different generations. And Gen Z, for them, they are priced out of the housing market, and so as a result, many are delaying household formation, and that has cascading implication on starting a family, population growth eventually, and even for the longer term, social security payment down the line. Anyway, so I think the Gen Z population is at the mercy of the baby boomers to transfer their equity wealth to them.
I think you're correct there. And one of the things I observed, by the way, and it was just something I stumbled on last night, and this, a lot of people are making political play of it, but the hay of it, the truth is, I noticed everyone was talking about the increase in the Army and military meeting its recruitment goals. But preceding every major recession since the late 1970s, there's been a spike in meeting recruitment goals. And that does seem to follow the 18-24-year-old job group or age group having an inability, if you don't have a college education, if you don't have a specific skill set, finding difficulty in the employment world and enlisting in the military. And it's fascinating to see how that traces out per weekly average earnings. It's an amazing comparison. And I think you're reflecting that with the Gen Z frustration. Just a quick take from you on that.
That's very interesting. I have not seen such a chart. I would love to see it. But I think, echoing your point, we also have seen that the unemployment rate of fresh college grad is at the, as high as 2009. And you can see that from the micro data in the household survey published by BLS. So, to your point, it's not just the Gen Z, younger, without college degree folks who are, I mean, it could be that they have college degree and they're still joining the Army. And it's probably because even with a college degree, those folks have trouble finding a job. There was even a Wall Street Journal article a couple of weeks ago that talked about how the unemployment rate of MBA graduates are at one of the unemployment levels is at one of the highest since the great financial crisis. So all this speaks to how the hiring rate has slowed down dramatically.
Well, let's go to some of your postings now, because one, I love to brag on what you say and what you're introducing. And you made a comment about, of all the news headlines that came out this week, and this is the most shocking, talking about Trump stating the Fed made the right call to pause rate cuts. At the same time, you seem to think that Scott Bessent's more worried about term premium and bringing that down. The 10-year is finicky, in my opinion, and I come from an older generation where we believe if the 10-year yield is falling and gold is rising in parallel with the dollar increasing in value, it's an indication of future problems with the economy or unseen risks that we can't dictate. Do you think Scott Bessent can achieve his 3-3-3 goals with instability in the bond market?
Well, I first of all, I want to agree with you that even at the more academic macro level, when you see higher dollar, higher gold value, and decreased 10-year yields, that's usually reflects safe haven effect. uh, could be due to global economy slowing, or sometimes could be even due to the problems originating from the U.S. but spilling over to abroad and spilling back. But the reason why I made that comment was because I was seconded to the White House Council of the Economic Advisor during 2019 to 2020 in the first Trump administration. And I remember that the two things that stir up the passion of the president the most, two economic things, was Jay Powell and strong dollar. And I thought that it was a sea change for Trump to be agreeing with the Fed's action, particularly because he has such a strong distaste for Powell. And just a couple days ago, he demanded that the Fed lower interest rate immediately. So when Scott Bessent followed up with that comment by saying that they are focused on lowering 10-year yields as opposed to pressuring the Fed, I thought now it makes a lot of sense why Trump said what he said. And I think this is a very positive development because, number one, there is some academic literature finding from a John Hopkins professor by the name of Francesco Bianchi that found that whenever Trump tweets about the Fed, it tends to, in the first administration, lower the 10-year yields, but in the current situation, it tends to raise 10-year yields. So if Trump does not reduce the frequency of criticizing the Fed, it's actually positive toward not raising the Treasury yields. Second, the 10-year yields basically runs through the economy, right? The mortgage rate is most linked to the 10-year yields. So to revive the housing market, first you need to bring down the 10-year yields. And in the past 4 months, we have seen this 100 basis point increase in 10-year yields, even though the Fed reduced rates by 100 basis point. I think Trump and Bessent now realize, especially for Trump, that the Fed does not hold the key to economic growth. Suppose that, there's still ongoing debate on what caused that 100 basis point increase in 10-year yields from September to December. But suppose that one of the hypotheses is that the market is questioning the credibility of the Fed in bringing down inflation. Now, suppose that that's the case, then Trump comes along and decided that, well, in fact, the most important reason for bringing down long-term rates is to reduce the fiscal deficit and generate or bring down inflation. And if he's successful, that's actually more effective in bringing down the 10-year yields than whatever the Fed, Jay Powell says. If it's true that the market is questioning the credibility of the Fed. So I think it is a very positive development in terms of the potential for the 10-year yields to come down. And naturally, without coercion from Trump and influencing the Fed's independence. And I think that the market still underestimated President Trump. My view of President Trump is that he's actually has a very intuitive grasp of the economy. One may question, how would Trump ever know what risk premium or term premium is? Well, he came from a real estate background, and anyone in commercial real estate understands that the long-term interest rate holds the key to the economy. And if he understands that, it could be that he just may be willing to take the short-term pain on the economy to wring inflation out of the system, finish the job that the Fed didn't finish because of the Fed's obsession over a soft landing. Well, Trump may come along, decide to, cut the deficit and usher in, as Scott Bessent says, a period of non-inflationary growth. Nobody has that in their baseline because nobody really believes that politicians are willing to do the right thing as long as they're short-term, if there's short-term pain. So I think it's very significant that for Trump to be focusing on the bringing down the term premium.
Fascinating, and actually, believe it or not, that's in my H1 forecast. So I believe that we're going to have some short-term pain for a booming economy in the last quarter of this year, and I believe it's going to be a result of wringing out the excesses, including, which you mentioned it, we have commercial real estate as the overhanging risk. While housing is slowed down dramatically, as our team has been analyzing, and the MacroEdge team does a fantastic job through the RE Sites website, guys. The commercial real estate threat to credit availability to small business and to individuals, startup companies, et cetera, especially in the regional and community bank arena, has not been recognized yet on the bottom line. With a new sheriff in town, do you think that Trump will push that forward once his administration team is completely in place and allow the natural flow of failures, defaults, et cetera, within tolerance to be completed and clean the cycle up a little bit so we can progress forward?
Yeah, I mean that is a very complicated question because I expect the administration to restructure which agencies has the power to supervise small banks, large banks. I expect there will be large changes to financial regulation and deregulation. So I think this is truly an open question.
Well, I'll follow up on that with one more. Do you find the speculative nature we're seeing in zero earning equities, the various coins, which the more descriptive term that cannot be used on Bloomberg television, this wild speculative frenzy that we're witnessing right now needs to be terminated or at least more regulated to prevent the fraud, which is causing distrust in our financial system, so we can get back to more traditional lending, credit expansion, et cetera?
Well, I think that the people who are entering into this current administration, many of them are of libertarian leanings and of inclination for less regulation over more regulation, and and I personally came from the university. Received my training from University of Chicago, so I do tend to believe that the market will weed out the excesses. Um, and I think also from the perspective of the voters, I think many people would not want to be in the business of using taxpayers' money to bail out um, popped bubbles in the world that you just described. So I think generally the administration will be taking a hands-off approach to those issues.
I respect that, and that's why I asked you, because you have worked with the Trump administration, and needless to say, with my screen name, obviously I have a more libertarian leaning and subscribe to the Milton Friedman Hayek school. So thank you so much for answering that. I'm going to bring Six from the MacroEdge Radio team. Six, please take over for a minute.
Hey Anna, big fan of your work. How you doing?
Hi.
Hi. So I had a couple questions as it kind of relates to markets. What do you think about how do you think that we should think about tariffs going forward? Because every time he says tariff, the S&P nukes 30 points in a couple minutes like it did earlier today. What do you think the real risks are there, and how much of that actually plays out versus is open threats, or is it really just too early to know?
Yeah. So my own thinking has evolved over time on this as well. So in the first administration, if that's any guide, the Kevin Hassett, who played a key role in designing those tariffs, was advocating for a more targeted approach, focusing on intermediate goods. And subsequently, the body of empirical studies within the Fed has found that if you focus the trade war on intermediate goods, it actually is disinflationary and it ultimately lowers the price level. And in the United States, 70% of our total imports are intermediate goods, with 30% in consumption goods. So in the first trade war, the consumption goods like your iPod, not iPod, that's from the 90s, right? No, your iPad and your iPhone were largely spared in that trade war with China. But I think my read of the current second administration is that indeed there are some things that are different. Is number one, I think Trump is thinking about his legacy. And the way he approached the trade war this time around is strangely very theoretically grounded. I know many economists would say, how could Trump not know Econ Basic 101 that tariff is inflationary? Well, in fact, that is not the lesson of Econ 101. In fact, if you open a basic undergraduate economic textbook, one way of thinking about the trade war is the prisoner's dilemma, 2x2 matrix. If you think that in the payoff matrix, in the trade war, prisoner's dilemma is that the best outcome from the perspective of the country starting the trade war, in this case the United States, would be if U.S. imposed unilateral increase in tariffs, but the other countries did not retaliate or did not retaliate fully. The worst outcome would be if one country is pro-free trade, whereas the other country is not pro-free trade and has been cheating. And the Nash equilibrium, which is when nobody's coordinating with one another and one is just choosing the best route forward, is actually one where both countries impose tariffs on each other. And from Trump's perspective, he is kind of determined to achieve that first best from the US, which is to have unilateral tariffs and force the trade partners not to fully retaliate. And this is the reason why, in the latest escalations, in his latest executive order, he added this retaliation clause, escalation clause, which did not exist before in the first trade war, which is that this time around, if the foreign partner decide to escalate, the clause says the U.S. will escalate some more. So basically, Trump is taking a very literal interpretation of that prisoner's dilemma matrix, where he's insistent that we stay on that matrix where it's unilateral with incomplete retaliation from foreign partners. That outcome is generally preferred to what he perceives to be the status quo before the trade war, which is that other countries are not in a free trade regime, whereas U.S. is. So to him, I mean, in this traditional payoff matrix, that's actually the worst outcome. He's sticking to that. The second, you know, very traditional economic theory is that there exists an optimal tariff, which can optimize a country's terms of trade. And that literature is as old as David Ricardo. And in the Handbook of International Economics, there was a chapter that did a simulation on what's the optimal tariff level for the US. And it suggested that it would be in the range of 20%. So it's just interesting that, we heard from Trump's during the campaign trail that 20%, he wants to slap 20% universal tariff on everybody. And that is it a coincidence that it happens to be the theoretical optimal tariff in these academic literature? So I also thought that was noteworthy. I think he is approaching this, and he is quite determined to drive tariffs up until he sees cracks in the economy. Trump is not a dogmatic person. The way he approached the world is he tests whatever ideas. There's like no, and then he observed how the world respond to those new ideas, and then he adapt to how the world responds to those new ideas. So I think most likely what's going to happen is that he is serious about pushing tariffs up because he wants to create a legacy of resetting the global relationship and the U.S. production pattern. And second, he doesn't really know what exactly is the pain point for the United States. He's skeptical about these traditional economists' claim that any tariffs is bad. So he's going to push the envelope until it's possible that Trump's de-escalation point would be when S&P 500 has fallen by 15 to 20%, or when the economy clearly is slowing down. So I think as forecasters, we just need to observe and keep track of a bunch of metrics and to predict when the escalation point. My personal prediction is that it will start to become very hard for the economy when aggregate tariffs reach about 8 to 10%. Right now, it's about 4% right now.
Well, here's another one. I'm sure you guys have modeled for this at Bloomberg. Off the top of your head, do you remember, like, maybe what levels of economic impact in as far as GDP do you think we could expect at a level of 20% tariffs, as you mentioned?
So I would tell you what the Fed thinks. So the basic general equilibrium that the Fed will have on their dashboard when they monitor the trade war will suggest that a 20% tariff will reduce GDP by 2%, about roughly 2 point something percent. But I think that would just be the upper bound. Personally, I think the true impact would be more modest, not 2%, maybe more, I think, along 0.8 to 1%.
Interesting. That sounds pretty substantial. And would that be kind of right away, or do you think that would kind of slowly accumulate over a period of quarters, years?
Um, um, I would compare. I would think about tariffs as like changes in exchange rates, and it takes about 2 to 4 quarters for big exchange rate changes to filter into trade volumes. So I think about 6 months is when I would expect to see very clear signs of impact.
Interesting. Thank you. I'm going to give it back to John.
And sometimes the mic doesn't want to work. Anna, thank you so much for taking those questions, because I was going to ask you I'll ask the question I was going to have Six ask you, and this is, what do you think becomes of what you just talked about with him if the PBOC decides to engage in a round of depreciation, which would, of course, infuriate Trump, in my opinion, not because I'm anti-Trump, but because I'm more observing how the trade war moves, even though only 15% of exports from China come to the United States.
Is your question about how Trump would react if the PBOC depreciates the renminbi?
Yes, correct.
Yeah, as I mentioned, the two economic things that stir up a lot of passion in Trump is Jay Powell and strong dollar. That's my own experience, and if you go back to his tweets back in 2018 to 2019, you will see a lot of tweet complaining about the strong dollar. So yeah, if I think China PBOC knows what it's doing, and it controls the renminbi in many ways. One of the ways is to set a daily fixing. And so far, even though U.S. has imposed a 10% tariffs on China, the daily fixing that PBOC has been doing has been quite strong, which is consistent with generally very constructive and collaborative negotiations between U.S. and China so far in this trade war. But I would say that, again, reviewing what happened in 2018 and 2019, there are some parallels to how Trump conducts a trade war. I mean, I mentioned just now the differences. Here's what I see as the parallels. Number one is that Trump is upset with Canada, Mexico, EU, for the same reason that he was upset at them in 2019. In 2019, he almost used emergency power to impose a large tariffs on Mexico. He also complained about the automotive sectors. I remember at the Fed, we were all worried about tariffs on the U.S. auto sector. And ultimately, he backed off from the Mexico tariff last minute. He also complained a lot about EU, particularly about the steel and aluminum. And then he also, I think for all our trade partners outside of China, Trump will continue to escalate with them, but the de-escalation will also happen very quickly. Whereas the trade war with China is more protracted and harder to de-escalate. I think that will be the same as in 2019. Sorry, I forgot what was the question. What was the
That's okay. You answered it precisely. I think that the PBOC would only engage in gradual depreciation of the renminbi, and I think you basically nailed it because I don't think President Trump is as spontaneous as you said, and as he was in 2018, 2019. And to be honest, I think he has a stronger team around him this time. Not? I wish you were there too, to be honest. But but I think, honest to God, I think he brought more people in initially in his first days of office who were more capable of dealing with this idea of a quote unquote trade war, including today's introduction of the threat of reciprocity uh, tariffs on the EU, which I think is why the market really took off down to the downside today.
Yeah, I think another issue here that's a little bit different than 2019 was the global macro context. In 2018 and 2019, China was not as weak on a macro level as now. In the past 2 years, China had a lot of trouble um, um, boosting the domestic economy. So as a result, the driver of the tepid growth they have been experiencing in the last couple of years was driven by external demand. And I think Brett Setzer did a very good job documenting the massive increase in trade surplus from China. And there's even an issue, and I expect this to become a huge policy issue at the U.S. Treasury, which is to an extent that China is even publishing trade figures in a way that seem to understate their current account surplus, because the Treasury gauge currency manipulations by looking at the size of the current account surplus. And so, Brad has a point that, in fact, the trade surplus of China has grown way more than their own data indicated. And so, in this trade war, it's possible that the U.S. may have uh, more pricing power, and I think that's the reason why Besant yesterday said that China may eat some of the tariffs, just because of U.S. currently is the fastest growing country in the world. EU is not doing well. China is not doing well, and all those countries are trade surplus countries, and we're really the only substantial buyers out there. So there will be more sharing of the incidence of the tariffs. It's possible.
Fantastic. Now, I always try to end the show with our guests. I don't want to abuse your time with us, although we could spend 3 hours easily. going into academics and economics analysis. You have been so fantastic and generous with your time. And we'd love to have you back on another time because you're able to go in depth and speak about matters that, well, geeks like me tend to enjoy, I have to be honest. We have had other economists on, Deborah DiMartino Booth and others, who have said that they think that there's a risk that the NBER might actually go backward looking and see that we were indeed in a recession since the spring summer of last year. What impact do you think that would have on Fed policy and Besant's policy moving forward, especially with the idea of trying to push the 10-year yield down further and maintain a lower federal funds rate if that were to occur?
I think the NBER, going back, the Business Cycle Dating Committee and the NBER, is just like those tree folks are referenced in the Lord of the Rings books. They take a long time to converge on a decision that, by the time they decide, everybody has already moved on. And for those of us whose clients are, these, institutional investors, fixed income investor, hedge fund people, what matters is what the 10-year yields move would be in the next, to tomorrow, right now, next week. And what NBER does, when all that's said and done, by the time they call a recession, it could be 3 years out. So I think that it's kind of not very relevant to either what Wall Street participants would care about, nor what Besant and Trump would try to do. If anything, if indeed there was a downturn last year, it means that we could be in a recovery this year. So if indeed there was a downturn, or indeed if there was a downturn in late 2023, then one should be more bullish about the period we're in, because it could mean that there's a strong tailwinds from recovery.
Anna, please remind everyone where they can find you. If you're working on a book, please break it on our show today. We all want to read it, obviously, and we do read your articles religiously from Bloomberg. Let everyone know where they can find you on social media. And of course, you really need a regular appearance on Bloomberg Surveillance. I'm just telling you.
Well, I can be found on Twitter, on X, at my handle is at Anna Economist, ANNAECONOMIST. And you can also find our research on Bloomberg Terminal at BECO, BECO, and then hit enter. And that's the landing page for my team's coverage of the global economy. And I encourage you to subscribe to our newsletter. I also do a call with our Bloomberg Terminal investors every Monday at 8:30, along with my colleagues Ira Jersey, Chief Rate Strategist Gina Martin Adams, Chief Equity Strategist Audrey Child Freeman, Chief FX Strategist, and also Mike McClone, Commodity Strategist. I hope to see you guys there.
We shall, and thank you, Anna, so much for your time. You have no idea how much we appreciate that. And that reminds me, I have to pester Ira Jersey to come on at some point in time. For MacroEdge Radio and Anna Wong, thank you, everyone, for tuning in. This has been a fascinating show and educational. Back to Econ 101 for all of us after listening to Anna. Good night, everybody.